Now, the other focus for investors, and of course all Australians really, has been about interest rates. So I'm going to bring in our special guests and we're going to start to talk about Property Australians' favourite topic. I've got Bryce, Holdaway and Ben Kingsley with me, two of Australia's leading property experts. They also have the Property Couch podcast, and they've helped millions of Australians cut through their debt and learn how to retire on $3,000 a week. That sounds pretty nice. I mean, $3,000 a week, I will take that. Gentlemen, thank you so much for joining us at AusBiz. I guess the big question is, now that we've had this interest rate 3 this year, what happens next? But what does that mean, Bryce, for the property market that's already so buoyant?
Well, the analogy that we talk about is it's kind of like having a bathtub with the water running in it and it's overflowing, right? Because you've got a housing policy that doesn't match the immigration policy. So that's already putting pressure on demand. And then you go and throw interest rate cycle cutting, that's just adding more fuel on the fire. So we kind of think that as a general asset class, it's a lot of pressure upwards. Within the niches, there's obviously intricacies, but generally speaking, that's just going to add fuel to the fire.
So Ben, where do you look then? Because you don't want to be looking at these oversaturated suburbs, perhaps, particularly in cities like Sydney and Melbourne, where you're not going to get a lot of growth.
No, what's interesting is that this is basically a rising tide lifting all ships at the moment. So we've got this housing shortage, but we've got a lot of interest in housing. Obviously, as money gets cheaper, with lower interest rates, we're going to see this happening. And so we are seeing Darwin as the #1 performing market in the country, followed by Perth. And then you look at Brisbane, and then you've got Sydney, Melbourne, and also Adelaide. And there's also a heartbeat again down in Hobart, with the only real market that probably isn't showing as strong a growth is the ACT market. So there really is a lot of picking that can happen, because when you look at the supply side, what we're seeing is, compared to where we were 12 months ago, we're in double-digit territory of undersupply than 12 months ago. So to Bryce's point, we've got all this demand coming through, and not just owner-occupiers. There is animal spirits from investors at the moment who are trying to get into that market. So it bodes for a pretty strong market for this spring selling season that we're about to see.
So what does it mean in terms of trying to be clever here then, perhaps, Bryce? You live in Sydney, you can't afford where you want to live, so you rent perhaps, and then you buy in Darwin. Is that sort of some of the strategies you're seeing, the rentvesting?
Yeah, we see it a lot, and we call it borderless investing, right? So it's kind of looking for a market that is, most of what we're looking for is long-term fundamentals, right? But then we want to try and create opportunities within those short-term waves. And so if you are living in Sydney and it costs a lot of money to be in this market, it kind of doesn't make sense that you would put yourself into a position under, cash flow stress, where you could go to, the markets that Ben was talking about, to go to Queensland or go over to Perth or even go to Adelaide. Or as some savvy investors have been doing of late, they've been going to Darwin. So it kind of makes sense to have a sort of national look at where you think your money will best suit you, and then create a lifestyle where you want to live. So if you are bound to Sydney, it's probably the #1 market to be a rentvestor for a lot of those housing affordability pressures that they're under, but they can still have their money working harder for them elsewhere.
All right, Ben, what about some of the myths when it comes to property investing?
Well, obviously, we want you to be a long-term investor. What we don't want is a market that's not balanced or sustainable, because we lose our social license as investors if it gets too difficult, right? At the moment, the balance is 70% owner-occupier and 30% investor, and the smart money should always be around following the owner-occupier. Okay, because otherwise you create speculation in the market, and that brings volatility and it brings risk. So when we start to think about that, we start to think about this opportunity of being able to say, well, I'm going to run a small private rental accommodation business, and I want to be able to get a return off that private rental accommodation business over the long term. Because if there's too much animal spirits, we're going to see a lot of risk coming into markets, including property bubbles in some of those markets. So I'm partially, the data tells me that we're going to see upside, but how much upside is potentially going to be a real challenge, and ultimately the politicians and the regulators will step in if they see too many animal spirits from investors coming into those markets.
Let's talk about some of the boring stuff. How do we save here? You're saying avoid BNPL, for example. You have to budget. What are some of the tips?
One of the things that we there's a few things, right? So first of all, spend less than you earn is the baseline, which is surprisingly talk to our grandparents, they love that. But look, one of the things we do is two things I can say to the question. One is a 7-day float for us, which is allowing you to have your money to swim between two flags, which means you work out what your discretionary spend is going to be like from Thursday to Thursday, and then you park all of your money in a primary account, which is an offset account if you've got a mortgage, or a high interest savings account if you don't. That's where you store your money. Once a week you get an automatic transfer into your living and lifestyle account, just a debit card. And all that's got to do is last 7 days, right? And you just swim between the flags. So we pay it on a Thursday. You do that because you're going to have a big weekend. That's where you spend most of your money. And come Monday,
so you're kind of paying yourself.
You are paying yourself, and you're seeing the money that's transferring into your household. That's not when you get paid. When you get paid is on a Thursday with your 7-day float, because that avoids unconscious overspending. Because all I do is look at my account and I go, okay, I've got this living and lifestyle account, and it can be $300 a week, it can be $1,000 a week.
So does that mean no credit cards?
We'll come to that.
Okay.
So
That's the second part.
well, for people who struggle with credit cards, the answer is no, don't get one.
Yeah.
For those who've got average or better money management, they do. Because what happens is they get all their bills on that, they get 55 days interest free, they get an automatic payment on that on the due date. It looks after itself, and then you stay swimming between the flags. So what does that mean? It means we can trap surplus and we put that money to work. The second thing we can do is if you talk to an investment savvy mortgage broker, they can. A lot of people are obsessed with borrowing capacity. We say important, but borrowing strategy is more important. And there's a few things that we can do around resetting loan terms and getting the structure of the lending right, which means that people can actually buy a property without impacting their current budget by being clever around how they restructure and taking a longer term view of holding 2 properties versus 1. So there's a couple of things I do, but the 7-day float, I think, is, if people just embrace that concept, they will be very conscious, because most people don't overspend by buying a holiday or getting a big TV. They overspend by tapping here, tapping here, tapping here, and then at the end of the month they go, how did that get out of control? And so that's
it's all those $5 coffees, isn't it? Okay, let's talk about negative gearing. And obviously there's a lot of political talk about this too, and whether or not it's going to be wound back. What's your view on what it is as an investment thesis, I guess?
So Juliette, we've always been a view that negative gearing is not an investment strategy. It's sold as a tax scheme as part of that story, but the reality is it is just a moment in time. So if I said, let's go and buy the corner shop and run a business, and we ran that business at a loss, is that a smart business decision? No, it's not. So what we need to do is think about it in terms of its context. So yes, we might need to borrow money to start the business, and if we're running at a loss, we do get obviously a tax refund at the end of that term of the 12 months. But over time, as we reduce that debt and as the income's coming in, that property turns to positively geared. So it goes through that cycle, and then ultimately that's it. So because at the end of the day, we're about investing for the longer term returns, which is the passive income and the capital growth over that long term. So we would advise against anybody who is thinking that I'm investing in property so I could save tax. Well, why would you spend $1 to save 30 cents? It just doesn't make sense.
I'm also curious, gentlemen, to get your thoughts on what the government has done with regards to trying to get younger people into the market with this 5% deposit. Great news for younger people, but is it just going to, as you say, lift all boats with the tide and really inflate the prices?
I think so. It's just putting more demand into the bathtub that's already overflowing, that's already going to get pressure from interest. All of the policies that both sides of politics put out during the election was pretty much lifting all the dominoes and just stacking the one underneath. But all it does is a rising tide lifts all ships. So in theory it's great because it's getting more people in, but it's not as if it's going to say, here's some money, and by the way, the prices are going to stay static. They're not. All of this injection means that they're still going to be chasing prices as they try to get into the market.
So if anyone was looking, would they be better off getting in now before October?
It's an interesting comment because effectively it's going to bring forward potential demand.
Yeah.
We know that through all the research that the deposit is one of the biggest barriers of getting into the market. So overall we love it. I mean, Bryce and I, even though we're talking about investing in property, we want Australians to own property, and that's why we only talk about owning a couple as opposed to trying to build a multi-million dollar, billion, sort of property empire. We're interested in that story. So I really like the idea of thinking about if you can move now and your market is moving, what we need to do is basically say, if the market's moving, get in. Okay, don't wait for that, because you're thinking that's going to be a reason to get in, or there is going to be a surge of demand after that time period. So hopefully getting in early, if you can afford it, soundly, and you're not doing anything silly or irrational like borrowing money on personal loans or something like that to get yourself in. It's all about sensible management.
Right, elevator pitch. How do I retire on $3,000 a week?
Very simply, just combine the super that you're paying, 2 investment properties, and think in decades, not years. Does the heavy lifting.
All right, gentlemen, thank you so much for coming on. Of course, Bryce Holdaway and Ben Kingsley, and they are the authors of How to Retire on $3,000 a week, and also the popular podcast, The Property Couch. Really great to have you with us on AusBiz. All right, we're going to just have a quick look